This is video 4 of example 11 dealing with the category financial liabilities at amortized cost. We have looked at the future cash flows that will happen over the term of the debenture, and now we can go and calculate our PV. Because we want PV, because that is the amount we're looking for, representing the fair value. On our cash flow function in our calculator, we enter cash flow naught as naught. The first amount you enter on your cash flow function, it will see as cash flow naught. Even if you mean it to be at the end of the year, your calculator cannot know that. The first amount you enter, it will see as day one immediately. So if that's the amount you are looking for, you need to enter this naught to tell your calculator, I don't know what that amount is. That is what I'm going to ask. That is what I'm looking for, PV. Then you start entering all your cash flows that you calculated. So cash flow 1 was the 100. Cash flow 2, important, there are 2 cash flows that happen on the same date. So you need to add them together. So cash flow 2 at the end of 2012 is both the interest and the maturity payment. 2 amounts happen on the same day, then you have to add them together. If you enter them separately, your calculator will see it as a year later. Then if we think about 2013, cash flow 3, again, 2 amounts happened. So you need to add them together. If you put them in separately, your calculator will see them as happening in separate years. If they happen on the same date, you have to add them together. Then we are going to use the market-related interest rate. So your I is your 14.1417%, and we ask for NPV if we use the cash flow function. It's the same thing as PV, it's just called NPV if you use the cash flow function, and that represents our fair value, 990 Rand. If we now go back to the first journal that happens on day 1, initial recognition, we now know that the debenture liability has to be recognized in terms of the rules of financial instruments at fair value, and we have just calculated that fair value. That was the PV amount of 990 Rand. This journal, however, now doesn't balance because the bank amount, what the issuer really received, was 950, was the discounted amount. Now, if this initial journal does not balance, the balancing figure, which can either be on the debit side or the credit side, is called a day 1 fair value adjustment. And that day 1 fair value adjustment goes through profit or loss. In this case, it's a debit entry. Therefore, it is an expense that you will recognize in other expenses. If you are in the category at amortized cost, this will be your only fair value adjustment that will happen. I just want to play what if for a moment. It's not the case in this example, but I just want to show you what would have happened if it had been the case. What if this debenture only matured once off at the end of the 3 years, not in installments? Then your cash flows at the end of 2011 would have been only interest. The cash flow at the end of 2012 would have been only interest. The cash flow at the end of 2013 would have been interest and a once-off, just one maturity payment. In that case, your interest amounts for each of the years 2011, 2012, and 2013 would have been exactly the same. So you could enter those amounts as payment in your calculator because they are equal every single time. What would also have happened is that there would have been no maturity payment at the end of 2012. The only maturity payment would have happened at the end of 2013. So that maturity payment at the end of 2013 you could put as future value in your calculator, because future value is one amount, once off, at the end of the life of an item. In the actual example, there are two amounts and they are at different times. You can't use this future value function. But if it had only matured once off, you would be able to use payment because the interest would stay the same, future value because it's only on one specific date, the entire amount would mature. Your N would be 3 years. Your I would still be the market rate of 14,1417%, and you could calculate PV on your calculator. Now, it won't be the same amount because it's different cash flows that happen at different times. I'm just trying to show you that if a debenture only matures once off, you can use those normal functions on your calculator. Payment, FV, NI, and calculate your PV.